welcome back to the Best Mortgage channel, where we break down everything you need to know about property financing. Whether you're buying your first home, looking to invest, or refinance, today's video is packed with actionable strategies to help you transform your financial future through smart property financing. Now, I tried to put all of these important items into one video, but I'm going to cut this important info into three parts. Some of the points are going to be kind of basic stuff, especially the first five, but as we get further along, they're going to get more advanced. Now, before we dive in, don't forget to hit that like button and subscribe so you don't miss any of my future videos and tips to help you save money and build wealth through real estate. So let's go into the first 1 through 5 strategies, the basics, right? These are strategies that you need to know before you even start looking at homes or investment properties. It's amazing how many times that people don't follow these. So let's just start, by crawling, and then we can go to walking and then to running in the third video. First strategy is to make sure you check your credit early, okay? And it's not just checking your Credit Karma score because it's going to be different than what we look at for mortgages. Okay. There's a difference between the score that your mortgage broker, your mortgage professional, not everybody's a mortgage broker like I am, or I have access to lots of lenders. I have access to over 150 lenders that I can do all kinds of loans, from residential to investment to commercial properties, right? A lot of people are just a loan officer at the bank that just is able to help you with the products that the bank offers, right? It's a little bit different than a mortgage broker, a mortgage loan officer, and a mortgage originator, right? The mortgage loan officer works for the bank, and the bank is licensed, and so they work for that bank. They don't really have a license to originate on their own. They're using the bank's license. The loan originator is somebody who takes a test and is licensed to originate loans in your state, right, or nationally. But they also only work for one lender. They may work for, I don't know, I don't want to name names. So they work for this one lender, and they offer the lender's loans and nothing else. And then a mortgage broker is an originator that has access to lots of different banks. So they may not have, 150 banks or more like I have. They may have 4 or 5, but they still will have more options than the bank or than a loan originator that is only working for one lender. So let's start out the basics. The next thing, the credit report. The credit report is one of the most important things, and that's why everyone's always checking their credit. But I get a lot of calls from people where they're saying, I really don't want to run my credit yet because I don't want to affect my credit. Well, this is why you fix your credit. This is why you're working on your credit in order to buy the house. So you need to use it now. This is the situation where you're going to need to use it. So telling the mortgage broker not to pull your credit, then what are you there for? You won't be able to buy a house without having that pull. Now, we can do a soft pull, right? The soft pull doesn't affect your credit, but it doesn't allow us to be able to pre-approve you, which we're going to go on into the next step. It only allows us to pre-qualify you because it doesn't have everything a normal credit report for a mortgage has. And that leads us to Credit Karma and all these other credit companies that check your credit. Okay. They use a different credit rating. They may use Advantage, or they may use, something else. But the FICO uses, the one we use is the Tri-Merge. It has 3 reports. It has TransUnion, it has Equifax, and it has Experian. Okay, so it has 3, and it also has public records. So if you had a foreclosure, a short sale, a deed in lieu, where you hand over your house in exchange for not having foreclosure shown on your credit report, it also doesn't show bankruptcy. So the Tri-Merge will show bankruptcy, whereas a soft pull may not. And it also shows felonies and that sort of thing. So it has public records on it, as well as the 3 credit bureaus on it. Okay. Your Credit Karma one does not. Credit Karma only has 2 credit bureaus, and it doesn't use FICO. It uses Advantage something. So it's typically only for credit cards or car loans or stuff like that. This one is specifically for mortgages. You have to understand that your credit score may be a little bit lower than what you're seeing on Credit Karma when a person like me pulls it. Okay, so you want to check that early. So if you see any bumps in there, anything that is out of the ordinary that may show up, you want to pull it early so that you can fix those things. So when you are ready to go forward, you know it, right? So if you pull it, you see, oh, everything's fine. Okay, well, that's great. I'm ready to go forward as far as the credit report goes. Now, the second thing to understand, the other strategy is to understand your what's the difference between a pre-approval versus a pre-qualification. Pre-qualification is a quick estimate. Um, versus a pre-approval that shows sellers that you're serious. You should always aim for a pre-approval. Most realtors won't show you any listings without you having a pre-approval because they're not going to waste their time showing you around when they're not sure that you're going to qualify for a loan. And the seller's not going to let you come in and see their house because they don't know whether you can buy the house or not. You don't have a pre-approval. The pre-qualification basically goes by whatever you're saying. So you're saying, hey, I make, $80,000 a year and I have great credit. My credit's, 720 or higher, and I have no foreclosures. I have no bankruptcies. I have nothing. So, and I've been working at my job for 2 years. So I have a steady job. I'm a W-2 employee. This is everything that you're saying. So when you're telling me this, I say, yeah, we can pre-qualify you based on what you're saying. It should be okay. But then the pre-approval looks into your 30 days of pay stubs. We collect 2 months of your bank statements to show that you have the money available to close your loan. We also collect information like your IDs and stuff to make sure you are who you say you are, Social Security, make sure that we clear you with Patriot Act, right? That we can show who you are, that it's not a fraud or it's not a person that is stolen someone else's identity. Those are things that we look at when we get the pre-approval. And once you get the pre-approval, we're going to run it through either Fannie Mae, Freddie Mac, or FHA, and it's going to say to us through their computer system, based on the information we feed it in, it should say us approved eligible. That means that this person is approved and everything looks good to go forward. They should be able to qualify for the loan. Now, you still have to go through underwriting, and the underwriter has to look at all these documents and stuff when you apply for a loan. But it's the next step, and it's a lot more sure than having a pre-qualification. So going on to the next strategy, number 3 would be budget more than just a down payment. Okay. Everybody calls and says, how much down payment do I need for this? How do I need for the FHA loan? How much do I need for the conventional loan? How much do I need for this? Remember, closing costs, inspections, and moving expenses are also in there, not just the down payment. You have to budget for these to make sure there's no surprises later on because there are taxes to pay. And a lot of people don't realize, but you have to pay your homeowner's insurance 1 year ahead of time at closing. So if your insurance for the year is going to be $1,500, that's another $1,500 that you're going to have to bring to closing. And then the lender is going to want to start, especially if you're putting less than 20%, an escrow account. Escrow account means an account that is used only for paying your insurance, your taxes, right? Or anything like that, fees that have to do with the house. Usually your HOA, which is your homeowners association, or your COA, which is your condos owner association, those are paid separately. So they don't come into play with an escrow account. But they do need to start an escrow account, which what happens is you make your mortgage payment and your taxes and insurance payment all at the same time in one. Okay. Now, if you can do more than 5% down, I have lenders that will do an escrow waiver so that you can pay your taxes and insurance separately. You don't have to bring, an extra $10,000 to closing because of the costs in the escrow and paying the insurance ahead of time. Usually for the escrow account, they'll collect 2 or 3 months of insurance and 2 or 3 months of taxes, but they can collect more depending on the lender to make sure that account is funded. And then they'll collect part every month as part of your mortgage payment when you start making your mortgage payment. So you need to make sure you have enough budgeted for those costs, or else you won't have enough to close. Later on, we can use more advanced techniques like getting concessions from the seller, especially in a buyer's market like we have today. We can get concessions. We're getting 3% concessions from sellers right now, where they're giving $10,000, $15,000 towards the seller's closing costs. Now that will help also because that sometimes can pay off your insurance and taxes. You can also use it for a buy down, that is to buy down the interest rate. Interest rates are high right now, but you can buy down the interest rate so your interest rate's lower, which I'll talk about it in a separate video. It's a really good strategy right now. But let's go into number 4, which is to shop around for rates. Okay. So don't just take the first loan offer you get. Talk to multiple lenders or work with a broker like me to find the best terms and the best pricing. And when I talk about best rates and best pricing, people tend to see that as being the same thing, but it's not. You can get a great rate, right? Let's say the rates are going for 6% and you're getting a 5.5% rate, but you may have to pay points. That means you may have to pay to get that 5% or that 5.5%. So let's say you pay 5,000 to get that 5.5% rate, or you pay $800 to get that 5.5% rate. That's where I'm talking about pricing, because you're still getting the same rate, 5.5, right? But one, you're paying $800 for it. The other one, you're paying $5,000 for it. So which one do you want? You want the one with the lower payment. That's the lower pricing, right? So rate and pricing is not really the same thing. Okay. And when we're talking about rates, typically you'll hear a thing that says par, par rate. So based on your credit profile, let's say you have a 750 credit score and your debt to income ratio is very low, maybe you're 30% or something like that, you're going to get a great rate, probably the best rate you can get. Whereas if you have a 580 credit score and your debt to income ratio is at 50%, you're going to get a worse rate. So your credit profile involves these two things. Sometimes you pay more or less, but when we talk about par, the par rate is what your credit profile gets you, the best rate that it gets you. So let's say your credit profile gets you a 6.5% rate, and someone else who has a worse credit profile than you gets a 7.5 rate. That person that got 7.5 rate can still get the same rate as you, but they would have to pay a thing called points in order to get it. Each point is 1% of the loan amount. And at that point, you're bringing down the rate. Okay. When you have a great credit profile and you're getting a great rate, you can also go up on the rate from your par. Let's say you were at 5.5% rate and you go up to 6% rate. And now the lender's going to give you money instead of you paying for that rate. It's going to pay you for going up on the rate. So sometimes that works in your favor. I just did a loan recently where the person was getting a 6.375 rate, and we went up to a 7% rate because to them the monthly payment was still comfortable, but they were going to get like $7,000 at closing, which helped them with their closing costs. That situation was great, and we were looking at possibly refinancing this loan in maybe 2 years or 3 years, with the rates being much lower. We're in a declining rate environment at the moment. That person can refinance in 2 or 3 years, and they got $7,000 to close, but now they're also going to bring down their payment in 2 or 3 years to a much better payment, right? So that $7,000 helped them to be able to afford the house because they may not have had the money to put as a down payment and with all the closing costs. So that $7,000 helped them with closing costs. So those are the kind of strategies that we use that are a little bit more advanced in order to get you into the house that you like at the rate that you want and the payment that you're comfortable with. Okay. And it all starts with the par rate. When I talk about shopping around for rates, I don't mean like what some people do. I get phone calls all the time from people and they're like, "Oh, what's your rate on the 30 year? And what's this?" And I'm just rate shopping. I just want to find out who has the best rate right now. I'm going to call a couple people. To me, that's kind of silly because it tells me that that person really doesn't understand what they're doing. Someone told them that they have to go shopping around for rates. That really is not the way to go because, first of all, every lender's got different rates. Okay. And those rates are different for each person based on their credit, their debt, all that stuff. So everybody's got different amounts. So you can just call around for rates. What number is someone going to give you? They're just going to give you the basic number that everybody has, the national rate. So you're going to get either the same rate from everybody, or and then later you're going to have surprises. Or if you take a few days to call, you may get higher rates the next day because rates may have gone up. Rates go up sometimes 2 and 3 times a day. So you have to look at that. If I'm calling today and I'm calling some lenders tomorrow, those lenders tomorrow may have higher rates or may they have lower rates, but they're not really lower, right? It's just that I called on a different day and the rates went down that day. So the lenders I called the day before are going to have lower rates also. You're not really comparing apples to apples. And that's why I say to a lot of people, if you can work with a mortgage broker like myself, you should always work with a broker over someone who's working for one bank or one lender. Because what that's going to do is that's going to get someone who knows what they're doing to shop for the rates for you. So I shop for people around 150 lenders and I look at it and based on what they're doing, oh, this person's got this situation or this person's got that situation, I may look at a lender and go, that's not the lender to go with because that lender is very tough on these situations. Or that lender is very lenient on this situation. Maybe I go with that lender instead because they have the best chance of getting their house with that lender. So there's other factors involved. And when you're dealing with a mortgage broker, also find out how many lenders that they work with. Because if they only work with a couple of lenders, 3 or 4 lenders, they're always gonna shove you through the lender that they feel the most comfortable with and the one that typically works for everybody. But not all lenders are created the same. Some lenders deal with plain vanilla loans. Someone has a W-2 who's had the same job for over 2 years, steady income, no problems on their credit. They're in the 700s. And then those same lenders may not do well with a self-employed borrower that has income that is changing all the time or changes from year to year or, you know, gets paid differently. They may get paid uh, through 1099s, or they may get paid through the business, or they may get paid some cash payments. You never know. So with those situations, we may go with a bank statement loan lender or a lender that can do 1099 loans, or even sometimes we have to do a hard money lender because something needs to be done quick and get the person to be able to buy their house before someone else gets it and then we refinance it into a loan that we can plan out how we're going to qualify for that. So that's some of the different strategies that we have. Strategy number 5, which I think is the most important one of the first 5 that we're discussing, is don't max out your loan approval. And what I mean by that is typically when someone asks me for a pre-approval, I give them the maximum amount that they qualify for. When I give you the maximum amount you qualify for, let's say I say $500,000, the maximum you qualify for, you shouldn't go out and look for a $500,000 house. You should probably be looking around 450,000 or 475,000. The reason I say that is because if you're right on the line, right, of the maximum, then the problem is, let's say your insurance comes out high or the taxes, let's say the person that's been living there has been living there a long time, so their taxes are low. And we're using that number to figure out your taxes for next year, right? When you move into the house, your taxes are going to go up. Now, if they have been living in that house for 2 years, it won't go up as much. If they've been living in that house for 40 years, their taxes are way, way, way much lower than what you're going to pay. And so once they figure out that calculation during the process of qualifying you, you could all of a sudden be over the edge and not qualify for the loan anymore because your debt to income ratio is too high. And then at that point, you're looking around for someone else to do a loan with you, co-signer, or something like that. So you don't want to be at the very, very edge. And what happens almost every single time someone goes looking for a house is they look at the $450,000 houses, and the $450,000 houses are not, you know, you like this other one that you saw that was 465. Okay. Now, if you were looking at for 450 and you qualified for a max of 500, no problem. But what happens if the maximum you were at was 450? I'm going to say, I'm sorry, you need to make more income, or you need to pay down some credit cards at closing. We're going to need a concession from the seller to help you pay that down, or you're going to need to borrow some money from a friend or have some family member help you so that you can get that money that you're going to need to close, because if not, you're not going to have enough money to close. So those are the kind of things that we talk about. So just because you're approved for a certain amount doesn't mean you should borrow it all. Okay, so stay within your comfort zone. So there we have it. Those are numbers 1 through 5 of the 15 powerful strategies to help you make the most of your property financing and create long-term wealth. So be sure to check out the following 2 videos showing strategies 6 through 10 and 11 through 15. And let me know which one of those videos, which one of the strategies you're most excited to try. Let me know in the comments below. And don't forget, strategy number 15 can completely change the way you approach property financing. So make sure to get more information on that one so you can one day be on the Forbes list under real estate. So if you found this video helpful, hit that like button, subscribe to the channel, and share this with anyone who's thinking about buying or investing in real estate. I'll see you next video.
Don't you want to save money? Boom. Don't you want to close fast? Boom. No stress and no fuss. Boom. Close your loan in no time. Boom. Click the link and start a loan. Boom. Or grab your phone and give a call. Or when you're short, I told you right at edge will help you own. Boom. 321-439-8110. Call. 321-439-8110. Call.